All right, so today I was going to make a video about dividend stocks, specifically dividend growth stocks that are Canadian. I'm going to talk about three stocks. The first one is one I've never talked about before, Go Easy. This is one that just trades on the TSX, so you're not going to find it on any of the American exchanges. This is a lending company, basically. They're obviously in the financial sector. This is a company that has grown just absolutely massively over time. I mean, if you go back to 2000, it's up 1,100%. The S&P is up 185. And the first thing I would point out here is that this is a company that's down a lot from its all-time high. I mean, it hit, let's see, it hit about, actually, that's not the price itself. So it hit in 21, it was over $200 a share. It hit about, looks like about 211, even higher, 211, 220. So again, it's down to 108. So again, we're down roughly 50%, give or take. So it's down a lot, but that's because it did very, very well in 21. I mean, look at the growth. It was down at $23 at the depths of the March crash. Again, going up that'd be almost 1,000%. Like that's just crazy levels of gains there. So again, it is, I would say it's priced maybe a little bit below average here. I mean, if we look at its PE 12.7, 5-year average 12.2, price of sales 1.7, 5-year average 2. So it's probably maybe a tiny bit undervalued here. But if you look at its 5-year growth compared to the S&P, it's actually absolutely destroyed it. 3-year growth, it's absolutely destroyed it. This company has absolutely destroyed the S&P in every way, shape, and form. And I mean, right now there's a big concern over banks and financial services companies. And this is a company that survived the dot-com bubble, the '08 crash, the March 20 crash. So it has been through three. I mean, the March, I don't think that was actually technically a bear market, but it has been through, again, if it can make it through '08 and the tech bubble, like the chances of this company going under, very, very low. So that's something that I wouldn't consider that to be a concern. But the main reason that I like this stock is it currently has a 3.5% dividend, but they're growing it absolutely incredibly quickly, right? 38% is over the last 5 years. I don't think that that's going to happen over the next 5 years, but even if they could go 20%, like half of that, that would still be very, very good. I mean, 2017, it was 72 cents a share. Now it's 364, right? I mean, even 21, they moved it from 264 to 364, right? That's $1 a share more. So, I mean, even if you go back 10 years, right, you would have a 36% yield on cost just if you bought it 10 years ago. That's how fast they're growing this dividend here. Let's go back like 20 years, right? Gee, I don't even... well, actually, I mean, let's go into if you'd have bought it in June of 2003, you'd have an 86% yield on cost, right? That's how fast they're growing their dividend, right? So, I mean, is everyone going to hold it for 20 years? No. Are they going to grow it as fast as they've grown it? No. But, I mean, if you can grow it at 20% a year, I mean, 72 divided by 20, that's roughly every 3.5 years, just off the top of my head, it's going to double. So again, if you hold it for 10 years, you're going to have 2.5 to 3 times the yield. So, I mean, you're looking at probably around, I don't know, 9 to 10%, just roughly. And again, that's just for 10 years, right? So the other big reason is people are hooked on spending more money than they have, right? People just want to spend. And there's a lot of people that spend above their means, and people who spend above their means, that's why stocks like this are so good. So, and again, I'm not necessarily for the concept of predatory loans. I think some people would accuse them of doing that, but again, to each your own, right? No one is forcing people to do that kind of stuff. And not only that, the people that accuse companies like this of predatory lending are the same people that support the negative incentives that lead to their bad habits anyway. I mean, if you look at its net income, look at how fast its net income is growing over the last 10 years. Just, I mean, in 2013, it had a net income of 14. I don't know if that's actually million or if it's in accounting terms, which would be billion, but whatever. And now it's literally 10x its net income in the last 10 years. So again, just crazy growth, and on top of that, you're getting this crazy dividend, right? Just crazy dividend. So again, this is a company that is a decent percentage of my overall portfolio, just because I think it has a lot of good qualities, right? Is it my number one stock? Is it a top 10 stock? Probably not, because I think there is a little bit of risk to a company like this. But given that it's done so, it's not that it did fine in these crashes, but it came out okay. The chances of this a company like this going under is very low, right? Very low. So that's the first one. The next one is, I think, a very, very safe company, and something that I think you're crazy as a Canadian not to own. CN. Again, everybody knows what CN is, Canadian National Railway. Current dividend, 2%. Dividend compounded growth rate, 11.6%. Payout ratio, 41%. So again, it is safe. Again, just consistently growing that dividend, just amazingly well. If you go back 10 years, you'd have about a 6.7% yield on cost. If you go back 20 years, you'd have about a, let's see, about a 29% yield on cost. So again, not as good as Go Easy, but still very good. And again, this is another company that has beat the S&P, actually very easily beat the S&P over the last 10 years. Let's check 15 years, even easier yet when you go back 20 years. So again, people hear about CN and they think that it's some boring company, but yeah, it's a boring company, but it's beat the S&P very easily over virtually every long-term time period. And you're getting a company that's growing its dividend very, very nicely, right? And does anybody really think that CN's not going to be around in 10 or 20 years? Like, of course not, right? And not only that, I don't think it would be conceivably possible for someone to build a new railway in Canada, right? So again, this is one of my few must-own stocks, in my opinion, not because you're going to get rich off it, but because it's so safe, at least as far as a stock goes, right? The last one I wanted to talk about is one I've talked about before. That's EQB. This is another dividend growth stock. Again, they're one of the smaller banks in Canada. Current yield, 2.49%. Dividend compounded annual growth rate, 22.8%. The payout ratio is at 20%, so very safe. Again, the dividend on this company isn't nearly as good as the bigger banks, usually 4 to 5%, but they're growing it a lot faster, right? And then that's exactly what I'm looking for in a company to buy, right? Again, another company that has outperformed the S&P over 10 years. Let's go back 15. Again, easier. It has been around since 2004. Again, it has outperformed the S&P as well during that time period, right? Again, previous dividend yield, you go back 10 years, you're looking at about 7.7%. I mean, if you go back to the start, it's about, 15% roughly. So again, you're buying this company for that dividend growth, right? That's why you're buying it. And again, I've said time and time again that the companies you want to buy are the companies that don't have crazy high dividends right now, but they're growing it very nicely, because you should be buying companies for the future, not for right now, right? And the companies you're going to have the best dividends on in the future are going to be the ones that are growing it the fastest right now, right? Again, I've just shown that, right? If you look at some of these super high, like the QYLDs, the JEPIs, some of the BDCs, some of the mortgage REITs, these high dividend yield stocks, ETFs, BDCs, whatever you name it, they have high dividends right now, but the share prices are usually pretty flat. Sometimes some of them even going down. Very few of them are actually growing over time. And on top of that, again, you're not getting any growth, right? So again, If your goal is, I just want to have income right now, okay, maybe you buy a JEPI, but 90% of us, 95% of us probably don't fall into that category, especially if you're watching something like this, right? So the key is you want to buy companies that are growing that dividend, because you're going to have more than a 10% yield if you hold companies like this over 20 or 30 years, right? So again, those are 3 stocks I like. In order of safety, I think CN is by far the safest, but as far as growth goes, I don't think it's going to grow as much. But like I pointed out, it's growing faster than the S&P, right? So again, what more could you ask for? So if I were to buy just one, I would buy CN. But I think that the other ones offer more upside in that they're growing their dividends faster. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe if you haven't already, and stay tuned for more.